Hi friends, Simit here from informedtrades.com. Today I want to kick off a new series of videos on price and value indicators in the stock market. We'll start with the price earnings indicator, what that is and what that's all about. Let's get started. Okay, key points. We'll start by taking a look at what the PE ratio is, how it's defined. We'll compare the trailing 12 months PE ratio versus the forward PA ratio. There's numerous kinds of PE ratios, and we'll talk about the big ones in this video. Those are two of the big ones. Another big one is the Shiller CAPE ratio. CAPE is cyclically adjusted PE ratio. It's an acronym for that. We'll talk about that. And then, does any of this stuff even work, or what are some ways that it can be used if it does work? So let's get started. PE ratio, it is price per share divided by earnings per share. So basically, what is the share price divided by the amount of profit or earnings that the company has on a per share basis. You take all the earnings, you divide it by the outstanding shares, that's your earnings per share. You take the market capitalization, which is basically what it would cost to buy the entire company, divided by the number of shares, then you have the price per share. Earnings, to be a little even more specific, is revenue minus expenses. This is slightly different than cash flow, and we'll do a video on cash flow, but based on how you calculate when you record earnings. So if you make a sale today, but you deliver the product tomorrow, does the revenue get recorded today or tomorrow? Those types of issues. So there's some room for companies playing games, manipulating the data, but in general, the idea is price per share over earnings per share, with earnings being revenue minus expense, a gauge of how profitable the company is. The basic idea with this calculation, or what this ratio is really telling you, is how much are you paying for earnings, right? So if a company has a very high PE ratio, you're paying quite a bit of money for $1 of earnings, for its future earnings. If it has a low PE ratio, then you're not paying much for a company with high earnings. That's so one way a lot of investors, sort of a traditional way of looking at the PE ratio, is a low PE ratio is indicative of a value deal, something that's on sale. A high PE ratio is indicative of something that's very expensive or has very high expectations for the future. So that's sort of a broad or simple concept. Again, we'll get into some of the nuances and where that may be appropriate or inappropriate shortly as well. Okay, so that's sort of the idea, price divided by earnings, to tell you how much you're paying for future earnings. PE ratio is a lagging indicator, and unless it's specified otherwise, you can assume that you're looking at the trailing 12 months of earnings. So it's the current price divided by the trailing 12 months, so the most recent 12 months of its earnings per share. So you take all the earnings over the past 12 months, you divide it by the number of earnings per share, that's your EPS. You take the current price, you take current market capitalization or price per share, and that's your numerator in the equation in the PE ratio. Now here's a chart looking from 1871 comparing the S&P 500, which is the gray area chart, with the blue line, which is the trailing 12-month PE ratio. And what this chart really illustrates is that there is no correlation. So, it's the S&P has gone mostly up. The PE ratio has sort of been up and down. There's not really a correlation between the PE ratio and the S&P 500. And some people, critics of this indicator, will be like, all right, that's, this is kind of useless. There's no correlation, it has no predictive value. So that's one thing to bear in mind, or something to consider. Now, one objection is that, well, the PE ratio, the trailing 12-month PE ratio, which is the default, if it's not specified, you can assume it's a trailing 12-month ratio. One criticism of that is that it's looking at the past, right? You're paying for, or you're more interested, especially as an investor, in what's to come, and you're paying for future earnings. So really, you want to be looking at an estimate of future earnings, and that's what the forward PE ratio is, which is the current price divided by an estimate of next year's earnings, of the 12 months going forward. So what is this company going to earn 12 months going forward? That's your denominator, and then over today's price, that's still your numerator. So that's sort of the idea. And S&P 500, this is going back to 1985, so some may say the sample isn't large enough. But from 1985 at least, you can see that there is an element of mean reversion, and that's sort of an idea that comes up even if you look at the trailing indicator, that's still an idea. You can see there's roughly in a range outside of the huge spike here, as well as the dot-com bubbles. There tends to be a bit of a range here, right? Generally, the top of the range is in the mid-20s, the bottom of the range is around 6. So you can sort of incorporate an idea of, maybe it's time to buy when it gets into the single digits, and maybe it's time to sell when it gets into the 20s. But again, there's no exact correlation, and you still want to be careful, because if you sold at 20 something here and it goes up to 123, that could really hurt if you don't have a stop loss in place. S&P 500 forward looking is a little smoother, at least from 1985. This is the average, and plus here's -1 standard deviation, +1 standard deviation. So forward earning, you could buy at 12. That's about where the minus is. That's sort of a buying sign of sorts. Maybe sell into the high teens, 17, 18. Forward estimates tend to be, one of the reasons why the forward PE ratio is often lower than the trailing 12-month PE ratio is because analysts tend to be and the company, everyone tends to be very optimistic about the future, of course, until it happens. And that really reveals one of the flaws in the forward PE ratio is that estimates of the future are just often wrong. So you're estimating or you're basing this indicator on an estimate, whether it comes from a group of analysts who follow the stock or the company itself. They may say, we believe we're going to earn X amount of dollars or X amount of euros, pounds, whatever, in the next 12 months. That's very, who knows what's going to happen. And so there can be a wide variation. You may have a forward PE ratio based on, what you think is going to happen in the next 12 months, today, what you think. But what actually happens is going to be different. And that's going to, hinder the legitimacy of your PE ratio, potentially. So that's a criticism of the forward PE ratio is that, it's just you're playing with numbers, you're picking them out of the air. At least with the trailing 12 months, you're looking at historical facts, company accounting records. So that's, the upside is that it's predictive. It's acknowledging that, we're interested in the future, not the past. The downside is, well, you can't predict the future. So that's forward PE ratio, but still same idea. There's a mean reversion concept, whether you're looking at either one, trailing 12 months, or the forward, you see there's an element of mean reversion, meaning it's going to come back and you want to sell the top, buy the bottom. That sort of idea. Okay, another PE ratio, the Shiller CAPE ratio, cyclically adjusted PE ratio. This idea says, you really shouldn't just be looking at 1 year, and you'll get a much more reliable, meaningful data set if you look at a 10-year period or a 5-year period. Some people like to use 5. Again, if it's not specified, you can assume that the CAPE ratio is in a 10-year period. So that automatically eliminates a lot of stocks that have only been trading. You won't be able to apply this to a lot of stocks that have been trading for a very small amount of time. But if you're looking at old companies or companies that have been around at least 10 years, you can get an idea of what has been their earnings, what has been their actual PE ratio over the past 12 months, or over the past 10 years. And then, of course, you would adjust that to inflation based on the U.S. CPI, inflation indicator, which a lot of people have qualms with. They say that's a massage or not an accurate reflection of inflation. At least it's some adjustment to acknowledge that prices tend to be rising. So we want to account for that in the PE ratio as well. And again, you sort of have a similar concept here. With all of these, the idea of buying a low PE ratio and selling a high PE ratio is sort of what all the proponents of these various types of PE ratios are getting at. And you can see that this comes from Robert Shiller. That's why it's often called the Shiller CAPE ratio. Above 28.8 is the red zone. You want to be looking to sell. 20.28 is the yellow zone. Maybe hold off. And the accumulation zone is below 20. So that's sort of a way to think about this. Does any of this even work? And we've talked about a bunch of this. Personally, the way I think of it, it's a long-term sentiment indicator. So over a long term, I sort of like the Shiller CAPE for this reason. It takes a bigger picture look. It can be a meaningful sentiment indicator. When a stock has a high PE ratio, it is a cause for question. Are people just too exuberant about the stock? Is the opportunity gone? That's something to think about. It works a lot better with large market cap stocks, right? So a small market cap stock that doesn't have any earnings, it's not going to be relevant. A small market cap stock that has enormous growth potential, right? And that's what people are speculating on. It may have a high PE ratio, but that doesn't necessarily mean that it's overpriced or overvalued or the market is over exuberant about it. So that's sort of where, personally, the way I like it is to look at it from the S&P 500 from a broad market perspective over a long term. I like to think it's a useful tool in that respect for a long-term investor who wants to get an idea of the big picture of the market. Warren Buffett and many other value investors like to find a way to compare the price-earnings ratio to government bond yields and other yields like dividend yields. Basically, one way they do this, or one key sort of idea in doing this, is to invert the price-earnings ratio and think of it as the earnings-price ratio. And when you invert it, it tends to be referred to as the earnings yield. Basically, what you're doing is you're saying, all right, I'm paying whatever the share price is, $50, $100, $5, $2, whatever, and what are the earnings that the company is getting from my investment? So you look at the earnings per share divided by the price per share, and that gives you a percentage. All right, if I'm investing $50 and the company's earnings per share is $5, that's a price-earnings ratio of 10 to 1, or it's an earnings price ratio of 1 to 10, which would be 10%. You can then compare this with government bond yields. All right, if in that example where a stock has an earnings yield of 10%, and if the government bond yield is 2%, well, you can sort of compare, all right, here's the premium I'm getting for taking the risk of investing in this stock versus the free government bond yield, or the risk-free, quote-unquote, government bond yield. And whether that's actually risk-free is another story, but the idea that it's backed by the government, thus is, or of reduced risk, or has, the government's stamp behind it, is something to compare to. And that's another criticism of the PE ratio, with the exception of the Shiller CAPE ratio, which takes into 10 years cycle. But a 1-year PE ratio doesn't really factor in macroeconomic things like the government bond yield. So Warren Buffett likes to compare price-earnings ratio to government bond yields. A lot of value investors, that government bond yield is sort of the starting point of their analysis. Using the by inverting the price-earnings ratio and making it the earnings-price ratio, the earnings yield, we can compare it to other percentages in other markets, like the government bond yield, like dividend yields if stocks are yielding dividends. So that's one technique commonly used by value investors. But the main idea there is to don't look at price-earnings ratio in isolation, but compare it to other metrics, namely the government bond yield. Intra-industry analysis, for instance, if you do a lot of fundamental analysis on industries, you might say, all right, semiconductors are an industry I want to be part of, apparel, technology, cloud computing, whatever. Once you say, all right, there's a big growth opportunity in this industry, let me find the winners in this industry. That's where you can look at PE ratio. You can say, all right, here's the industry. There's 20 companies in cloud computing, for instance, that I want to focus on. Let's see which one has the most of a value opportunity, the lowest price earnings ratio. That's something to think about. Still, though, ultimately more stuff is needed. So you cannot just rely on price earnings in isolation. You can sort of find a way to incorporate it. A lot of people, and I think there's a big opportunity in sort of tweaking indicators. For instance, especially if you want to compare it to government bond yield, come up with your own formula, and make that your own indicator. That gives you a competitive edge, gives you something proprietary. So this is a good starting point, but ultimately I think a lot of investors may need to flesh their strategy out, and sort of, if you can appreciate the concept of what price earnings is telling you, the price of future earnings, you can think about whether you're a value investor and how this might play in. That's about it. Price earnings ratio is a big topic. This is just meant to give you an overview. Any questions you have, anything you want to talk about, share it with us at informedtrades.com. Best of luck in your trading, and we'll see you next time. Take care.